Well, hello again. My name is Robin, and I'm joined with Kirill. So yeah, we are both very interested in stocks, especially in value investing, and we want to share our basically all knowledge that we captured throughout the years.
Yeah.
Share our opinions with like-minded individuals, and of course, we want to show you the tool that we built, which you can also acquire. Please note that everything that's in this video is not financial advice in any given way, shape, or form. Please read the disclaimer in the description as well. All right, so today we're gonna tackle.
What do we got? What do we got?
We got Tesla.
Sure.
Nice.
Yeah.
Because these days we feel like there's a lot of hype in the market without the foundation or the fundamentals to back it up.
Yeah.
So basically that's what we're going to show you. In this video it will be Tesla. There will be some more videos coming out of some also, of course, some stocks that are well priced, let's say, or
Yeah.
at
So
least
basically, the reason why we decided to also choose Tesla is that you can, if you go and check the S&P 500, right, it's 4,400 in terms of the price right now, and well, according to quite a lot of metrics, is just simply put very expensive. And we just in the example of Tesla, we just want to show you, how expensive it is. Like, what's the actual price you should pay for the stock, right? If you're willing to invest in Tesla for the future, and then just see what are the good things, what are the bad things about it. So, let's get started.
Let's get started. All right. So first, let me switch over to our tool. And if you haven't seen our last video, you can check it out still, because we'll go into more depth about like all the metrics. But we try to make it more concise. We'll go over them and what it means, but we'll try to go over it a little bit faster. So first, TSLA, and what you do is you type in a ticker, click on the exchange it's on, and it will load the data in.
Yeah.
So what you're first greeted with is the summary, some of the basic ratios, just for you to see already, and of course current price and the fluctuations today. So I see that it's already down by 2.01% today.
2%. Oh wow. Yeah,
that's quite hefty.
Yeah, but let's hope it's gonna go even further down. So if you're interested to buy it, you can just get a good bargain on it.
So let's see what the price actually needs to be for that.
Yeah.
So quick company foundations. They have revenue growth, they have net income growth, free cash flow growth, which is really good, of course, and their debt is covered by their free cash flow, or at least their long-term debt.
Yeah.
Do they do share buybacks? No, they dilute you with 10% in the past 5 years.
Yeah.
Or 8.2.
That's actually a bad signal. If I recall correctly, I think Elon Musk also bought Twitter.
Yeah.
Also, when he got a loan, I think he got some of the Tesla shares in exchange. So maybe that's also one of the reasons why it got diluted.
Probably that. We can also check in a bit. We'll also see it in the income statement where it fluctuates the most.
Yeah.
So then dividend growth, they don't have any dividend. For me personally, that's not really a big deal. But yeah, if you're really into value investing and you like dividends, then you might want to pass on Tesla.
It's more like a growth stock, right? So for them, it's more important that they actually make sure that they got consistent free cash flow growth and the revenue growth, right?
Yep.
And keeping their margins safe,
Exactly.
So that means that they're gonna have some, or they still have some competitive advantage on the market versus like other car makers.
Yeah. So rather that they want to make the shareholders happy with dividends, they rather invest it back into their own company.
Yeah.
So for the income statement, well, we can check the shares outstanding first. Well, we see that it has been rising consistently, but not a real big spike during the Twitter deal. It seems around that time.
It's actually probably quite normal for them to dilute their. Maybe what also could be the case, which is actually quite common for large tech companies, is that they do the, let's say, the share bonuses for their employees. So then they, instead of them giving a bonus, let's say in cash, they just issue more shares for them.
Okay.
So that's also something, if you're interested, to look further, to do further deep dive into Tesla, something to consider when you're, for example, checking the earnings release or, like, for example, their annual report. So.
Yeah. Cool. Well, we said that they could cover the cash flow by with their long-term debt, and we can see that they have around twice as much free cash flow as they have in long-term debt, which is good.
Yep.
Can we see where they acquired a lot of it? Not really. They have been paying it off, it seems, or at least some of the loans have been expiring.
This is actually rare because when we, for example, checked Apple, right, they
Yeah.
actually acquired quite a lot of debt because it was
Yeah,
cheap, right, because
exactly.
of like low interest rates. But for Tesla, they got it the other way around apparently.
Yeah.
It could be an error in our, let's say, software, but I can just double check in the
Yeah, me
meantime,
too.
yeah.
Just quickly.
If we can just
But
balance sheet.
I would doubt it. So let's see for their long-term debt.
Yeah.
So total long-term debt. No, it has been decreasing.
Yeah.
Yeah,
Okay,
yeah.
then it's very. I mean, it's actually very nice of them, right? Because then they're keeping their, balance sheet to healthy standards,
Yeah.
right? But then on the other hand, maybe they're actually missing out on this free money, or they did miss out because maybe if they wanted to fuel their expansion, like
Exactly.
having money.
Yeah, you
in the
don't know
pocket
what
is
the
always
loans
good.
are, of course, that they had. So.
Yeah. It's more like a speculation, of
Yeah.
course, but yeah.
All right, cool. Then going over the statistics, quick recap. You can find the link to the description of the book used for these metrics, so that you can also read up on it. Shortly, whenever the numbers are green, it's good, of course. Whenever they're red, they're bad. So what do we like to see? We like to see net earnings ratios around or above 20%. Well, we see that they have been increasing quite a lot in net earnings ratio, so they have become profitable since 2020,
Yeah.
which is of course great for Tesla. But still, it's still on the low side, so they have some difficulties converting net revenue into net earnings.
Yeah.
The interest expense ratio, okay, so might be that they wanted to pay off their debts because of high interests.
Could be. That actually could be the case when, if they have some very hefty debt, if they're actually able to, have like some nice free cash flow flowing in, if they're able to pay it out, why not?
Exactly.
Yeah.
Well, we see that in the last 2 years it has been nice, around 3 to 1%, but it has been fluctuating quite a bit, so that's also something to keep in mind. You actually also want to see some kind of steady numbers. If it's fluctuating this much, it's also some kind of signal that there's something going on in the background.
But it also could be the case that because they had to fuel their expansion, right? So to build a facility in
Yeah,
Berlin,
sure.
I think in China,
Yeah.
right? So they had to actually had quite a lot of expenses, right?
Indeed,
So
yeah.
maybe that was the case there.
Could be.
Yeah.
Then for the R&D, well, there's something positive here. So they now have relatively low R&D, which you would also like to see, right? Because
Yeah.
if you have a lot of R&D, I keep bringing up the example of Coke, but they have zero R&D. They have the brand, they just market the product, and that's it. They have such a huge moat on their brands that they don't actually need the R&D, which is also a very positive sign. And here we can actually see that they have a lot of R&D, probably has to do with self-driving vehicles and all the new tech coming into the Teslas. And then now you see that they actually slow down on their research and development, probably because they have the moat and they also have the fan base and they have the technology now, which is probably also out of the ballpark of the competition for now. Also has to do with their batteries, of course. I think they're still one of the
charging station networks and all that stuff as well. Yeah.
So that's actually really good for them. And also, if you're looking, of course, to buy the stock, it's also something very positive to see.
Yeah.
For selling in general, expense ratios, it's also declining. It wasn't really high to begin with, but now we can see it's actually going to the low 10%. We've seen this before because I think Tesla has a very limited marketing budget for.
They don't have a lot of commercials, do they? Right?
No, that's.
Yeah.
I think that was the whole thing about Elon Musk. They said we don't do marketing. Well, they obviously do, but they do it differently. They try different tactics, and they don't try to spend a lot on marketing. And it shows here as well. You can see that in 2020 they spent 9% on stuff like that. So it's really good to see. It sells itself. Of course, you have Elon Musk, the man behind, which is of course one big ass marketing magnet.
Yeah.
Basically, so.
Just need his Twitter account. That's more than enough yet to sell the thing. Yeah.
Then for the depreciation gross profit margin, on gross profit margin, you also want this to be as low as possible. We can see that it's a bit higher here, but again, it's a manufacturing company, so it's gonna be a bit on the high side as well. And they have huge facilities, so it's
as long as they have good demand going, right, and then they do not have a lot of inventory piling up, then it's a good sign. So what it means in here is that the lesser the percentage here, the better. So if the demand is still there, right? But then you just gotta also be careful as a competition. If they're gonna go ahead, especially in terms of, let's say, the pricing or the quality, right? Then Tesla might have some hard times competing with them. I think they already started reducing prices in China for some models. So that's also already a signal.
Yeah, it's also of course a different market. China is really different in that aspect. They have a lot of their own EVs going on in China, so they have different kind of competition than, for example, in Europe and the States, because we don't now you see influx, especially in Europe, with Chinese electric vehicles. But it's when I used to live in China for a short while, it's you saw a lot of these Chinese EVs that you've never heard of in Europe and still haven't seen.
Yeah.
So they have a huge array of electric vehicles and they're just pushing them out.
Yep.
So that may be why. So the free cash flow per share outstanding, basically the higher the number the better. It's just the amount, the big of the piece of the pie of the free cash flow that you have per share.
Yep.
So what can you say about the €2? Is it or $2?
Well, if we check the price, which is $230, right? I would say it's still rather low, of course, and especially given the rate of dilution for the stock. It's something which you probably just want to keep on rising. But then again, since it's still at the end of the day, some people say that Tesla is like a technology company. At the end of the day, their main output, their main drive of the revenue is their cars, right? And then they sell the additional services on top of that, or like some perks, technology thingies, right, as a service.
Yeah, you also see those arguments that when you're buying Tesla, you're also buying into SpaceX and Twitter, or X as it's called these days. But then again, you're not.
They don't share the balance sheet.
True,
they don't share the expenses there. So
so you're really not. You're just.
You're not. Yeah, maybe it's in your mind that would be the case, but in reality, yeah. If SpaceX would be publicly traded, it would be a different story. You know, it's the same with like Virgin Galactic, let's say.
Yeah. So we already discussed these free cash flow growth, revenue growth, net earnings growth, shares outstanding growth, and dividend growth. So no need to go over them. Okay, for the fund Smith investing ratios, we already covered it last time. So it's basically a hedge fund manager that has become extremely high returns across the board.
Yeah.
And these are some of the ratios that you liked.
Yeah, exactly. So it's just 5 basic pillars. So first one is return on capital employed. That's one of them, the Terry Smith that the fund manager is looking at. And as you can see here, that's actually, interestingly enough, the past 2 years were actually quite good for Tesla. So 20%, 30%, that's good sign. So hopefully they're actually improving on this aspect. Similarly to gross profit margins and operating profit margin, but in here again, because it's a car manufacturing company, they still cannot really have a lot of premium, enjoy such a great mode which would allow them to just bump up prices as much as they want. So they still got to compete, so that means their margins are also going to go slimmer, especially in the future if the bigger players like Volkswagen, like maybe Toyota, if they're going to start going into the EVs market further, then it might get tougher for Tesla. Cash conversion, simply put, as we mentioned in our previous video, the bigger the better. So it means the company's ability to convert the net income into the final dollars or euros or whatever other currency they're dealing with. So as you can see, it's in higher 50s, 40% for Tesla. It's not above average. It's pretty much, I would even say, according to the average S&P index, it's fine, but it's nothing outstanding here either. Interest coverage, because of the fact that they actually paid out a lot of debt of theirs, they are also able to easily cover up their remaining debt. So that's kudos for Tesla when it gets to that. So yeah, good job on managing their debt. That's actually quite rare, especially among the bigger companies where they have quite a lot of, let's say, R&D and other expenses. So yeah.
Right. Well, now we get to the fun part, of course. So you're probably wondering, okay, cool. So, well, we have a bit of a mixed bag here, to be honest. Not everything is really that bad, and some things aren't really that great. So, looking at the fundamentals, you can make up your own mind. Is it something you really want to purchase?
Yeah.
There are, of course, some red flags for me personally, share dilution and other kinds of aspects, which might hold me back from purchasing Tesla a bit. But yeah, that's of course up to you. But then, what would it be worth? Well, we have a couple of ways of checking it, of course. But then again, you only have 3 or 4 buttons to play with here. So super easy for you. Just fill in everything that you want in order to get your assumption out there, and you get the price. Yeah. So let's find. We are already at Stock Analyst anyway. So there are 2 ways of finding out the growth points that you might want to use. So we can use the free cash flow increase, or we can use the analyst forecast. So for here we can use the stock analysis tool, or at least the website. You go to stockanalysis.com, type in Tesla, go to the cash flow statement, turn around so that 2013 is first, and or whatever year.
Yeah, just to make it
Chronologically.
convenient. Yeah.
So we go to free cash flow growth. So this is all negative, right? But we can just take these numbers.
Yeah, it might be a little bit hard for Tesla because they were cash flow negative for quite some time.
Yeah.
So, and also keep in mind that, let's say, these are just, let's say, the starting points for your analysis, right? So if you just want to do the quick review of the company, which you're not, have never heard before, or have never like dealt with, you don't know their business, that's something which you can just consider as like, okay, check the past performance of the company for the past years. Or maybe also, as Robin said, you can just check what are the analysts, what are the professionals are forecasting for the future growth of the company.
So here we see, for example, 104% growth in free cash flow. Again, we've seen it before when we check the analysis. I'd say it's too big to use in R2 at this point.
And it's especially, as you can see, so they've been cash flow negative for almost all years, apart from the three last ones, right? And our tool also says that they actually have, for the past 5 years, they have negative free cash flow in the end. So maybe what we can put somewhere in the middle. So if you let's check the Yahoo Finance. What they say.
So if you want to check out the analyst assumptions, you can go to Yahoo Finance, TSLA of course. You go to analysis, and you scroll all the way down. And then here, next 5 years, it says it's going to increase by, let's say 11%, which is a bit more conservative.
I would say maybe we can just even double it or triple it, just to see how.
Yeah, let's double it.
What the assumptions are. How realistic would it be?
So let's put into 22%. So for the PE ratio, you go to macro trends. So again, TSLA. Whatever, doesn't matter. You go to price ratios and then PE ratio, click the 5-year button. And then, okay, so here we go.
So in this case, of course, because they were negative when it gets to net income and free cash flow, right? So it was 0. And then at some point they probably had tiny little bit of earnings at the end of the day, right? So that's why their PE was just like above 1,000, right?
Yeah.
But then in the end, I don't think it's very realistic. So if we check the past years, that was what's the low, what's the high?
So it's like 34 is what I'm seeing, and then like 1,134.
Maybe we can put it, let's say, the low of 30, and then the high of 60. Let's say a double.
Yeah, let's try that.
Because then, even though for, let's say, the average market of the well-established players like on the auto production industry, it's unimaginably high numbers, right? But we can assume that Tesla would be able to sustain its growth, right? So, for example, what we're trying to do here is just try to find as realistic of a scenario as possible, right? Given, let's say, the amount of information we got, And then, but if you, for example, have different risk tolerance or whatever, you can still tweak it around, see what suits you best, and your also investing profile, your style.
Exactly. All right. So then, for the required rate of return, there we go. I like to keep this at 12%. So again, as in all of our videos, the reason why is because with the S&P 500 you make between 7 and 10% annually. So because you're stock picking, you want to have a bit more returns, right? Because you're also taking on some more risk. So in this case, we take 12%. The discounted rate, I also put 12%. It's up to you. You can just play with these numbers. And then for me, I personally always use a margin of safety of 20%. You can make it higher or lower depending on your risk tolerance and also on your age. If you're a bit older, I'd say put up your margin of safety a bit higher. When you're younger, you have a lot of time to recoup like potential losses. So you can put it a bit lower, and so that's why I have it on 20%. So for you, you always say that, or at least what you mentioned constantly is for tech companies, or at least also with, for example, Tesla, it might be better to put it on 2 or 5 years because there's also a lot of things happening in the market.
Yeah, especially you cannot really predict what's going to happen with Tesla in 10 years, to be honest, because they have been developing also so rapidly. You never know, maybe they're going to switch to hydrogen cars all of a sudden. So 5 years is probably just as a safer bet, but also just to get back on the margin of safety part. Apart from what Robin has mentioned, also what's important to consider, if you do not know the company, if you do not know the business, and if you see it's actually quite risky, as of an investment, you can also increase your margin of safety to mitigate these risks. So you can also keep that in mind, especially if you do not know Tesla, but you still want to just curious to check what valuations look like. You can also increase the margin of safety to your preferences. Yeah,
exactly. So that's also something what I like to do is just increase the margin of safety and see where the price is at when I just keep increasing it to see where the margin of safety is at the current price, let's say. So that's also something to consider.
Yep.
So we press the analyze button, and it's going to take a little while to run all the numbers. Okay, so after it loaded, we can now see what the valuation actually is. So we see an average valuation of all the formulas that we use of 155, and the current price is 227. Besides the intrinsic value or the NPV formula, everything is below the current price.
Yeah.
Also average valuation, and then considering a margin of safety of 20%, you would likely want to buy this at like $124. So yeah, it's almost double the price of what you actually want to pay for it.
Yeah, but it also, given the fact that we actually gave, like, our assumptions are actually quite generous, considering, let's say, the average of the car manufacturing, like that auto industry, right? They got very low P ratios, they got very low growth rates because they're already quite established, like Toyota, right? Like Volkswagen, like what else are out there? Honda, all these kind of guys. So even if we give such generous assumptions, it's still overvalued. So maybe, hopefully, if the market is gonna go down a little bit in the future, maybe if you're interested to buy it, you can catch it at a little bit more interesting price ranges. But for now, it's just simply too pricey, right?
Yeah. All right. So of course now you might be wondering, where do you get this beautiful tool? You get it on 930.com. So here you go, 930.com. You go to get access today. You pay the price, and you get access. So for the first 5 people, you'll get it for $1, and after that it will be $15 forever. No subscriptions.
Yes, exactly.
Flat fee, $15. It won't change.
If it does change, you can just kick us in the butt for that, for sure. But let's say the whole idea of why we're doing this way is that we just see that there are so many other tools on the market like that where people are just putting enormously high prices on their tools. But what our mission is just to make sure that investing is accessible to as many people as possible.
Yeah.
So that's why we just actually want more people to acquire these tools, and then be able to make educated decisions when it gets to the investing, and not just like, okay, I want Apple, I want Microsoft, I want whatever. No, you can just easily check it within a matter of minutes. If certain stock is something worth of your consideration for investment, and you're good to go. But you can also just run it, and then, for example, if you wanted to buy Tesla, but according to your assumption it's just too expensive, then you can just potentially save loads and loads of money on not buying certain stock. So I hope it actually worth the at least $1 of your investment for the first 5 people, and then for the rest it would be 15.
Yeah.
So
For sure.
Hopefully.
That's a good speech.
Yeah, thank you.
Anyway, thank you for watching. And if you want us to cover another company, then let us know in the comments below.
Yeah.
And we'll see you in the next video.
Yeah, and please feel free to share your feedback, your comments, maybe your additional questions. We would really appreciate your feedback and all your involvement in this. Yeah, thanks a lot.
Thanks.